Hello everyone. Welcome to Self-Smart Money. Here are assets that are generally considered safer than cash, along with explanations for each. 1. Government bonds. Government bonds are debt securities issued by a government to support government spending and obligations. They are considered low risk because they are backed by the government's credit and taxing power. For example, U.S. Treasury bonds are seen as one of the safest investments globally due to the stability and creditworthiness of the U.S. government. 2. Certificates of deposit, CDs. CDs are time deposits offered by banks with a fixed interest rate and maturity date. They are insured by the Federal Deposit Insurance Corporation, FDIC, up to $250,000 per depositor per insured bank, which provides security against bank failures. CDs generally offer higher interest rates than regular savings accounts. 3. Money market funds. Money market funds are mutual funds that invest in short-term, high-quality debt securities, such as treasury bills and commercial paper. They aim to offer a higher return than regular savings accounts while maintaining a high degree of liquidity and stability. These funds are considered low risk because they invest in highly liquid and low-risk assets. 4. High-quality corporate bonds. Corporate bonds issued by financially stable companies with strong credit ratings, typically rated as investment grade, are considered relatively safe. These bonds provide regular interest payments and return the principal amount at maturity. While they carry more risk than government bonds, high-quality corporate bonds still offer a good balance between safety and yield. 5. Gold. Gold has been a store of value for centuries and is often seen as a hedge against inflation and economic uncertainty. It retains intrinsic value and is less susceptible to currency devaluation or market fluctuations. Investing in gold can be done through physical gold, coins, bars, or financial products like ETFs, exchange-traded funds, that track the price of gold. 6. Utility stocks. Stocks of utility companies, electricity, water, gas, are considered safe investments because these companies provide essential services that are always in demand, regardless of economic conditions. Utility stocks typically offer stable dividends and lower volatility compared to other sectors. They are a good option for conservative investors seeking regular income and capital preservation. These assets provide varying degrees of safety and return, making them suitable for different investment strategies. While they are generally safer than cash, it's essential to consider factors like inflation, market conditions, and personal financial goals when making investment decisions. Diversifying investments across different asset classes can also help mitigate risk. 7. Savings bonds. Savings bonds, such as U.S. Series I and Series EE bonds, are government-issued bonds designed to offer a low-risk investment option for individuals. They are backed by the U.S. government and can be purchased directly from the Treasury. Series I bonds offer protection against inflation, while Series EE bonds offer a fixed interest rate over time. 8. Treasury Inflation-Protected Securities, TIPS. TIPS are U.S. Treasury securities designed to help investors protect against inflation. The principal value of TIPS increases with inflation and decreases with deflation, as measured by the Consumer Price Index, CPI. They pay interest twice a year at a fixed rate, which is applied to the adjusted principal, ensuring that the return keeps pace with inflation. 9. Municipal bonds. Municipal bonds are debt securities issued by states, municipalities, or counties to fund public projects. They are generally considered low risk because they are backed by the issuing government entity. Additionally, the interest earned on municipal bonds is often exempt from federal income tax and, in some cases, state and local taxes, making them attractive to investors in higher tax brackets. 10. Dividend-paying stocks. Stocks of well-established companies with a long history of paying stable and growing dividends are considered safer investments. These companies often have strong financials and operate in mature industries, providing a steady income stream to investors. Dividend-paying stocks can also offer capital appreciation potential, making them a good option for conservative investors. 11. Real estate investment trusts, REITs. REITs are companies that own, operate, or finance income-producing real estate across various property sectors. They are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. REITs offer a way to invest in real estate without the complexities of property ownership and can provide regular income and diversification benefits. Blue chip S, when considering these safer assets, it's crucial to evaluate risk tolerance and time horizon. Diversification across different asset classes can help reduce overall portfolio risk and improve returns. 12. TOCs. Blue chip stocks represent shares of large, reputable, and financially sound companies that have a history of reliable performance. These companies often have strong market positions and generate consistent earnings, making their stocks less volatile compared to smaller companies. Blue chip stocks are considered a safe investment because they tend to be resilient during economic downturns. When considering these safer assets, it's crucial to evaluate your investment goals, risk tolerance, and time horizon. Diversification across different asset classes can help reduce overall portfolio risk and improve returns.